Unrivaled Nation, I'm planning on going to Disneyland later this week. I'm excited about it, but after I saw how much it would cost, I said to myself, man, oofa, poofa, I'm really going to have to refresh my Disney numbers. I previously did a video on Disney, a couple of videos actually, calling out that I actually liked it. This was back when Disney stock was in the doldrums, and I was saying to myself, you know what? At the time, you were effectively just buying the parks and getting everything else for free. And when you have that type of setup, it does smell interesting to me as long as you're not looking at a melting ice cube. Now, since then, the stock is up around 40%. So let's refresh the numbers, see what's going on with Disney, look at their underlying fundamental results. Management talks about a new era of building across their various different assets, ESPN, their streaming segment, their studios, their experiences, and looking at a interesting slate of movies. Unless some of the overly, I'm hesitant to use the word woke, but as long as they're able to identify with most people, with these videos, with these movies, I'd say this is an interesting lineup. Did the Deadpool versus Wolverine, the trailer at least shows to me that they're, expanding their palette a bit in terms of, their willingness to show certain concepts. And that might be more appealing to more users or more viewers. We'll see. But overall, I'd say that the lineup is actually quite reasonable, what they're showing here. Maybe there'll be more flops, but overall, I'd say this looks like a reasonable lineup in terms of kids' favorite movies like Moana and Frozen, Toy Story, combined with some things that people really like Deadpool and Planet of the Apes. But we'll see. In terms of ESPN, they're planning on, and this has been something they've articulated for a while now, they're planning on spinning off ESPN as a standalone service, along with working with various different strategic partners. Overall, this is a segment where the underlying economics haven't been up to par, I'd say, recently. And management's also saying, look, we need to, improve the profitability in our streaming businesses. And, the goal is to get to double-digit margins over time with this. The challenge is with price hikes, which is what they've done, you've seen a churn in user base. And so in their core Disney Plus domestic base, it declined both on a year-over-year basis and a sequential basis by several 100,000 subscribers. Internationally, it's growing much better. Still on a sequential basis, declined recently. Hulu, I think, is growing faster. The one true area that continues to just be a rock star business, and this is what I've called out from the beginning with Disney, is their experiences business, formerly parks and experiences. But, you're looking at a lot of different things. They're domestic, they're international, they're consumer, and across the board doing quite well. Domestic revenue up year over year. International really rocketing and rolling from 1.1 to 1.5. Consumer products roughly flat around 1.4 billion in the quarter. And you see their profit margins expanding nicely. I mean, this business is doing very, very well. Experiences is a crown jewel of an asset for Disney. And they're taking these profits from their experiences segment and they're returning it to shareholders. I'd say last quarter's presentation shows that they are becoming much, much more friendly to shareholders, partly because they can. They talk about, because they can with the free cash flow of the business, where they talk about raising their dividend payment by 50%, increasing their buyback, targeting a $3 billion share repurchase in 2024, how they're on track for $8 billion in free cash flow. So showing a significant improvement in free cash flow. It is always worthwhile to reflect on valuation multiples. So based on that $8 billion free cash flow that they're talking about, you're not talking about dirt cheap territory. You're talking about, type of mid-20s type of valuation multiple. So that it is worthwhile to think about, okay, so maybe you're getting, like a 4% free cash flow yield that can go back to you, plus the inherent growth of this business. And so, is this business going to be growing in the years ahead? They certainly seem to have pricing power. You look at their parks business, every year pricing power. With something like streaming, it's much harder. And you see the churn dynamic. Management very clear. Look, we're talking about billions, $7.5 billion in annualized cost savings that they're expecting. So a lot of very favorable initiatives that they're trying to reward shareholders. Why are they doing this? Well, it comes back down to if they don't do it, Wall Street is very upset with them over the lackluster returns over the last few years. And there's a proxy fight where activist investor Nelson Peltz looking to change things up. And so now you're seeing management say, okay, we gotta do whatever it takes to make sure we're able to keep our jobs. So the question is, where does Disney stock go from here? In full disclosure, this is not financial advice. And also, quick plug, recently an Unrivaled Investing subscriber posted in our exclusive Discord server that, this is a direct quote, "I've recently paid my second annual subscription and couldn't be happier. I've profited enough already to cover the next 20 years of subscriptions." It's not hyperbole. I actually did the math. That's a direct quote. Come check out it. Check out unrivaledinvesting.com for compelling ideas, market commentary, and such. I share my own personal investment journey. And also for the premium tier, I will personally let you into our exclusive Discord. Looking at Disney, thinking about where it goes in the years ahead, I think it is worthwhile to understand at the heart of this business, you still have their linear networks, linear TV networks, being a core profit driver for this business. And that business is struggling. That business is structurally challenged because people are increasingly cutting the cord, increasingly switching to streaming. And so even this trend will continue. 12% revenue decline, 7% drop in profitability. That is the heart of the issue with Disney, and it will persist. I'd say the silver lining here is that management is getting more serious about profitability in their direct-to-consumer segment, and you can see how the loss went from roughly $1 billion last year to $100 million in the most recent quarter. So that is a favorable trend, and it is growing 15%. So it is somewhat offsetting, the linear networks. And direct-to-consumer can be a wonderful business. Just look at Netflix, but it is tough. Then you think about parks, their experiences business, and they're doing very well internationally, and you can see some of their international ventures, some of their international bets that they're making, and they look legitimately pretty cool. The challenge is that all these things cost billions of dollars in terms of capital expenditures. And so that is one of the key aspects that hurts the free cash flow of this business, is how much they have to constantly reinvest to keep it fresh and to keep, to grow. Is that this is a capital intensive business ultimately, that in order to grow the business. And going back to the framework that really got Disney, that got me excited about Disney when I called it out last year here on YouTube, looking just at their experiences segment, you can no longer sort of make the claim that, experiences alone, that alone could give you meaningful upside. Now, you have this aspect where, if you're just going to think about experiences alone, maybe you have 50% upside, maybe you have 30% downside, 40% downside, if you were just to value it off of experiences. And, experiences, once again, this is a crown jewel of a segment, 30% profit margins, historical ability to raise pricing. And keep in mind, this is hypothetical. Of course, stock price can go higher or lower. But unlike when I called it out last year, it's no longer at a price point where you could say with confidence, this one segment easily covers the market cap. And so then my view is actually more aligned with what I have here with AI Ticker Chat. Check that out in the link below. First month is free. Where, if there's poor execution, only 4% growth in the years ahead. And keep in mind, this partly includes linear decline and only marginal profit expansion. And let's say a sub-market multiple, then you could be talking about, 30% downside from here. But if you have solid execution, maybe you're talking about closer to 100, 150% upside. And that is the real key aspect to Disney that I think it's worthwhile for investors to reflect on now. Last year, when you're talking about an $80 stock, not, this $113 stock or $115 stock, last year, when we were talking about it, you could just say, hey, will experiences still be around? Will their parks business still be around? Will people still be, buying the Disney products, the merchandise a few years from now? And, their history of pricing power suggested yes. Their history of record demand in the parks suggested yes, despite all the negative headlines. And so that was the aspect of Disney, the park business will do well. The challenge now is that you're at a price point where they need to execute on everything else. Before, you didn't have to worry about it. Everything else, that was hey, that's just a cherry on top. Now, with where the valuation is, you need to see that execution in direct-to-consumer, which is arguably a much harder business than what their legacy linear, cable TV type of business was. Linear, channel entertainment segment, where it's much less lucrative for now. and it's just much more competitive, where they're saying, hey, we're going to win in this, and they're looking at subscriber loss. So it is worthwhile to understand the valuation now is incorporating execution, very good execution for the business. If management delivers, arguably the stock might have, 100% upside from here. But it no longer has that sort of value case study where, the value investors go, oh, this is great. Heads I win, tails I don't lose much type of dynamic. Whereas here now, if they don't execute or if there's a recession, and that parks business, if the parks engine stalls because there's a recession, then I think you definitely get, shareholders get whacked over the head again, just because that is clearly one of the drivers of profitability. And then, you already have one of their other engines stalled out, which is the linear network business. So that's stalling out. If you were to have a recession, shareholders really would get whacked over the head. But so far, it's shareholders have been rewarded if you were picking it up when it's just like, hey, it's just the parks that you're paying. Now you're paying for execution. Now you're paying for ESPN showing much better margins or better partnerships, looking at their international expansion, which they are, looking at continued growth in parks and being able to effectively stabilize and eventually get to Netflix type profit margins with direct to consumer. They're nowhere near that. They're currently unprofitable, and they're not even talking about getting to 20%. They're saying double digits. So anywho, I hope this video has been helpful for you. I do not own shares of Disney. I think there are personally easier stocks and stocks with more upside potential. I call out one of them here on this channel, Fairfax Financial. That's one of my holdings. You can check that out if you're interested. And so I look at Disney, and for those shareholders that own it, I hope it works out for you. I just think this is at this point, it's an environment where they need to execute in order for shareholders to get a favorable return. I hope this video has been helpful. Thanks so much for tuning into Unrivaled Investing.